Imagine waking up to the news that the United States, long considered the world's financial anchor, is now at serious risk of yet another credit rating downgrade. How did the world's largest economy reach this precarious point? And what does it mean for everyday Americans? With the national debt soaring past $38 trillion and major credit agencies already stripping the U.S. of its coveted AAA status, alarm bells are ringing across global markets. Will borrowing costs surge even higher? Could investor confidence unravel, triggering a chain reaction through stocks, bonds, and even your mortgage rates? As the stakes climb, one question looms. Who will ultimately bear the cost of these mounting fiscal pressures? In this unfolding drama, is it the policymakers, the markets, or the citizens who will pay the highest price? In the world of global finance, three names stand out as the ultimate arbiters of creditworthiness: Standard & Poor's, Moody's, and Fitch. These are the largest credit rating agencies, and their assessments can sway the fate of entire economies. At the top of their rating scale sits the coveted AAA rating, a symbol of absolute trust and reliability. Only nations or institutions with the strongest financial foundations and a proven ability to meet their obligations earn this distinction. Why does this matter? Because a AAA rating signals to investors that lending money to such a country is as safe as it gets. Lose that status and the cost of borrowing can surge, shaking confidence across markets. The stakes couldn't be higher when it comes to these ratings. America's journey through credit downgrades tells a story of mounting fiscal concerns and political gridlock. In 2011, Standard & Poor's delivered the first blow, stripping the United States of its coveted AAA rating, citing a lack of a credible long-term plan to reduce debt and the chaos of last-minute debt ceiling negotiations. Fast forward to 2023, and Fitch followed suit, pointing directly to persistent partisan divides and irresponsible fiscal policy-making as reasons for their downgrade. That same year, Moody's echoed these warnings, highlighting Washington's inability to manage the nation's finances responsibly and the recurring brinkmanship over debt obligations. Each of these downgrades signals not just a loss of prestige, but a growing skepticism among global investors about America's willingness and ability to address its fiscal challenges. The common thread: political dysfunction and a stubborn refusal to rein in deficits, raising the question, how long can this trajectory continue before the consequences become unavoidable? Why have the world's largest credit rating agencies lost confidence in the United States? The answer lies in a pattern of partisan gridlock that repeatedly brings the government to the brink of default. Last-minute negotiations over the debt ceiling have become routine, signaling to investors that America's leaders struggle to make responsible, timely decisions. Instead of presenting a credible long-term plan to reduce deficits and stabilize the nation's finances, Congress remains locked in political battles. This inability to address structural fiscal challenges not only erodes trust, but also raises the risk of further downgrades. Are these warning signs being ignored, or is the system simply too divided to act before the consequences become unavoidable? Do credit rating downgrades actually matter, or are they just numbers on a page? The reality is far more serious. When a country like the United States loses its top credit rating, borrowing costs rise, not just for the government, but for everyone. Higher government interest rates ripple through the entire financial system, pushing up mortgage rates, car loans, and business financing. This means ordinary people and companies end up paying more to borrow money. Investor confidence can also take a hit, making markets more volatile and uncertain. So, a downgrade isn't just a technical adjustment, it's a warning signal with real consequences for the economy and for every household. When trust in U.S. governance the ripple effects extend far beyond Wall Street. Investors in global markets begin to question the reliability of the United States as the world's financial anchor. Could this loss of confidence trigger capital flight, higher borrowing costs, or even a shift in global reserve currency preferences? As fiscal irresponsibility persists, the specter of further credit rating downgrades looms ever larger, sending a clear warning to policymakers and citizens alike. Is the United States prepared to face the consequences of its mounting debt and political gridlock, or will continued inaction push the nation into uncharted financial territory? The world is watching, and the stakes have never been higher. The scale of U.S. government debt has reached unprecedented levels, with the national debt now surpassing $38 trillion. This figure alone is staggering, but what's even more alarming is the rapid acceleration in interest payments. In fiscal year 2025, the government spent $970 billion just on servicing this debt, nearly one-fifth of all federal revenue. Each year, these payments have grown dramatically, outpacing the nation's economic growth and squeezing the federal budget. With debt increasing by $1 trillion in just 71 days, the trajectory is clearly unsustainable. How long can this cycle continue before it triggers deeper financial consequences? The numbers paint a sobering picture, raising urgent questions about the future stability of the U.S. economy. From 2020 to 2025, the United States has seen a dramatic escalation in its annual interest payments on the national debt. In 2020, the government paid $345 billion in interest, a figure that steadily climbed each year. $352 billion in 2021, $357 billion in 2022, $361 billion in 2023, $365 billion in 2024, Fitch, and $370 billion in 2025, $476 billion in 2022, $659 billion in 2023, and $881 billion in 2024. By fiscal year 2025, interest payments soared to $970 billion. This means that nearly 20% of all federal revenue is now spent solely on servicing debt, not on essential services or investments. The sheer scale of these payments highlights how much the nation's financial flexibility is being squeezed. With such a large portion of revenue locked into interest, what will be left for infrastructure, education, or health care? The numbers raise a sobering question. How sustainable is this path, and who ultimately bears the cost? Looking ahead, the trajectory of the national debt paints a sobering picture. As the figure edges closer to $40 trillion, the sheer scale of interest payments threatens to consume an ever larger share of federal resources. Will the government be able to sustain this growing obligation? Or are we approaching a breaking point? Each year, more revenue is funneled towards servicing debt rather than investing in the nation's future. This relentless cycle raises critical questions. Can policymakers rein in spending, or will the debt spiral continue unchecked? The answers remain uncertain, but the risks are mounting, and the consequences could ripple through every corner of the economy. The relentless accumulation of national debt is more than just a number on a government ledger. It represents a growing financial burden that will inevitably fall on the shoulders of current and future generations. Each dollar borrowed today must eventually be repaid, either through higher taxes or reduced public services. This means that the decisions made now directly impact the economic prospects of our children and grandchildren. When debt rises faster than the economy's ability to generate income, it signals fiscal irresponsibility and undermines long-term stability. The government's obligation to service this debt diverts resources away from critical investments like education, infrastructure, and healthcare. Ultimately, this pattern of borrowing without a credible plan for repayment creates a legacy of financial strain, limiting the opportunities and choices available to future Americans. Imagine for a moment that the government starts with a clean slate, no debt, no surplus. Suddenly, a crisis emerges and the government needs to raise $2 trillion quickly. To do this, it issues bonds, borrowing money from investors with a promise to pay it back with interest. But where does the money to repay these bonds actually come from? Their answer is simple: taxes collected from citizens. Every dollar borrowed today is a future obligation that taxpayers must eventually cover, whether through higher taxes, reduced public services, or both. This means that the growing national debt isn't just an abstract number. It's a financial burden that directly impacts every household, now and for generations to come. Is another credit rating downgrade for the United States just a matter of time? The reality is, rating agencies don't simply look at the sheer size of the national debt. They scrutinize the government's fiscal discipline and the patterns of political decision-making. When deficits keep rising year after year and lawmakers repeatedly fail to agree on sustainable long-term plans, red flags go up. Political gridlock and the absence of credible reform send a clear message to the world. The system is struggling to correct its own course. So is it any surprise that the threat of further downgrades hangs over the market like a dark cloud? The agencies are watching not just the numbers, but the behavior behind them. If nothing changes, the next downgrade seems less like a possibility and more like an inevitability. Warning signs are flashing across the financial landscape, and they can no longer be ignored. Year after year, the United States runs persistent deficits, spending far more than it collects, a pattern that shows no sign of slowing. Meanwhile, interest costs on the national debt have ballooned, now consuming nearly a fifth of all federal revenue. This means less money for essential services and greater vulnerability to economic shocks. At the same time, Congress remains deeply divided, unable to reach consensus even on basic funding measures. With gridlock in Washington and fiscal discipline nowhere in sight, the risks are mounting. Are these just temporary setbacks, or are we witnessing the early stages of a much larger crisis? One of the most alarming signals in the current fiscal landscape is the absence of a credible long-term plan for essential programs like Social Security and Medicare. These pillars of the social safety net face mounting financial pressures. Yet policymakers remain deadlocked, unable to implement sustainable reforms. Meanwhile, the national debt continues to outpace the growth of the economy, creating a widening gap that raises serious concerns about future stability. When debt expands faster than GDP, it becomes increasingly difficult to manage obligations without resorting to drastic measures. This imbalance not only threatens the solvency of key programs, but also undermines confidence in the nation's fiscal health. The question remains: how long can this trajectory continue before it forces a reckoning? What happens if the United States faces yet another credit rating downgrade? The ripple effects could be severe and far-reaching. Mortgage and car loan rates might surge, making it more expensive for everyday Americans to finance homes and vehicles. Businesses could find it harder to borrow, slowing down investment and hiring across the economy. Market volatility would likely intensify, shaking investor confidence and amplifying uncertainty. And in the worst-case scenario, Treasury auctions could even fail, forcing the government to scramble for buyers and potentially triggering emergency interventions. Are we prepared for these consequences, or are we simply hoping they won't materialize? What happens if the Federal Reserve steps in and resorts to more money printing? The risks are far from theoretical. Injecting additional liquidity into the system might provide short-term relief, but history shows it often comes at a steep price: higher inflation. As the value of the dollar erodes, everyday goods become more expensive, squeezing consumers and savers alike. But that's not all. Those with assets like stocks or real estate may see their wealth grow, while ordinary wage earners fall further behind. Does this intervention truly stabilize the economy, or does it simply shift the burden onto the public, deepening the divide between the wealthy and everyone else? The question remains: is this a solution or just another gamble with long-term consequences? Can the United States truly fix its mounting debt crisis, or are we simply delaying the inevitable? There are only three main solutions on the table: and each comes with its own set of daunting challenges. First, the government could cut spending, but history shows that slashing budgets is politically toxic. Few leaders are willing to risk their popularity by reducing benefits or services. Second, raising taxes might seem straightforward, yet it's deeply unpopular, and even confiscating all the wealth from the richest Americans wouldn't make a significant dent in the national debt. The third option is to print more money, which may offer short-term relief but risks fueling inflation, weakening the dollar, and widening wealth inequality. So, which path will policymakers choose, and at what cost to the nation's financial stability and the everyday lives of its citizens? The answers remain uncertain, but the stakes have never been higher. Why is cutting government spending such a political minefield? The answer lies in the harsh reality that few politicians are willing to risk their careers by slashing popular programs or benefits. Every proposal to reduce spending quickly becomes ammunition for attack ads, turning fiscal responsibility into political suicide. In Washington, maintaining voter support often outweighs making tough, necessary decisions for the country's long-term stability. Even modest attempts to trim the budget are met with fierce resistance, both from within Congress and from the public. As a result, the cycle of rising deficits continues, with no credible plan to rein in expenses. Is it any wonder that the prospect of meaningful spending cuts seems more like a fantasy than a feasible solution? Many argue that raising taxes, especially on the wealthy, could be the solution to America's mounting debt. But does this belief hold up under scrutiny? Even if the government were to confiscate every single dollar from the top 100 richest Americans, the total sum would amount to around $3 trillion. When compared to a national debt exceeding $38 trillion and growing by trillions each year, this extreme measure would barely make a dent. The reality is sobering. The scale of the debt far outpaces what can be raised through the higher taxes on the rich alone. So, is simply taxing the wealthy enough to solve the crisis? Or is this just a comforting illusion in the face of a much deeper problem? Printing more money might seem like an easy solution to the mounting national debt, especially when political gridlock makes spending cuts or tax increases nearly impossible. In the short term, this approach can provide quick relief, keeping the wheels of government turning and avoiding painful fiscal decisions. But what happens next? History shows that excessive money printing almost always leads to higher inflation, gradually eroding the purchasing power of everyday Americans. As prices rise and the value of the dollar weakens, trust in the currency can begin to unravel, both at home and abroad. Is this a risk worth taking, or merely a temporary fix that sets the stage for even greater instability? The temptation is clear, but the long-term costs could be far more damaging than the immediate crisis. In the end, the reality is clear. America is not facing immediate bankruptcy, but the path it's on is deeply troubling. Exploding national debt, rising interest costs, and persistent political dysfunction signal that the country's fiscal health is deteriorating. Major credit agencies have already sounded the alarm with recent downgrades, and the warning signs are only growing louder. Without decisive action to address these challenges, another downgrade seems not just possible, but likely. The consequences could ripple through financial markets, impact borrowing costs, and erode confidence in the U.S. economy. The question remains: will policymakers confront these hard truths before the situation becomes irreversible? When the next credit rating downgrade strikes, it is almost certain that politicians will scramble to point fingers elsewhere. They'll blame external factors, global instability, or even each other. But the truth is much simpler and far more sobering. The burden of fiscal mismanagement doesn't fall on lawmakers. It lands squarely on the shoulders of ordinary citizens. Higher borrowing costs, rising interest rates, and reduced government spending on essential services are just a few of the consequences that ripple through the economy. In the end, it's families, workers, and businesses who pay the price for years of irresponsible decisions. So, while the headlines may focus on political drama, the real impact is felt in everyday life. long after the cameras turn away. Looking at the current trajectory of America's fiscal health, it's hard to avoid the conclusion that another credit rating downgrade is not just possible, it's highly probable. The warning signs are everywhere: ballooning deficits, soaring interest payments, and a political system seemingly incapable of meaningful reform. If the pattern holds, we could see the next downgrade as soon as late 2026 or 2027. Those rating agencies aren't just reacting to numbers. They're watching for responsible governance and credible long-term plans, both of which appear to be in short supply. The consequences of another downgrade could ripple through the economy, affecting everything from borrowing costs to investor confidence. So, is this a crisis in slow motion, or are we simply ignoring the inevitable? One thing is clear: unless there's a dramatic shift in fiscal discipline, the next downgrade is only a matter of time. So, what happens if the United States faces another credit rating downgrade? In the best-case scenario, the markets shrug it off and life goes on with little to no impact. Essentially, a non-event. But what if things don't go so smoothly? The worst-case scenario could see borrowing costs spike, mortgage and loan rates climb, and investor confidence shaken. Stock markets might become more volatile, and the government could be forced to make tough choices on spending. The ripple effects could touch every American, from Wall Street to Main Street. Are we prepared for either outcome, or are we simply hoping for the best while ignoring the risks? So, after everything we've explored, where do you stand? Do you believe the current market turbulence signals a rare opportunity, or is it a warning to stay on the sidelines? Share your thoughts and strategies in the comments below. Your perspective could spark an important discussion. If you found this analysis valuable, consider subscribing for more timely updates and insights. Thank you for staying with us until the end. Your attention and engagement are what drive this channel forward.